Thank you so much for coming to check out another episode of the Stash Cast, where we have interesting conversations with interesting people focused around the world of commercial real estate and prop tech. The Stash Cast is brought to you by Needle. What if you could use data and analytics to predict real estate transactions? You can with Needle. Come check it out at needle, NEDL.us to learn more. We have a new website actually, and we're actually going live here in beginning of September. So come and check it out for real this time. Today, I am super excited. I probably have one of my favorite people to talk to in the business. I have Bryan Barrett, the CEO of Barrett Stokely. And Bryan, thank you so much, man. I'm super excited to talk to you.
Absolutely. Happy to talk to you as well. This is my first time on a podcast.
This is going to be great. So,
Hey.
I, you and I have been talking since about the time I got into the business. And one of the things I always liked about you is that you weren't a dickhead, first of all, which you very easily could have been to a young new guy, but you took my calls and we always had good rapport. So that's one of the reasons I like you so much. But again, I know who you are. We've been talking for
Sure.
some time, but why don't you give the folks at home a little idea of who you are and what you do?
Sure. First, I would say thanks for having me. I've never done this before, but your persistence, as always, is one of your great qualities in business and has led to a lot of your success. I couldn't turn you down. So I will get better as we go, hopefully, here as I get used to being on the camera. But yeah, Barrett and Stokely is a multifamily investment management firm out of Indianapolis. Uh, and we own and manage roughly 10,000 units, central Midwest. We are not, how do I say this? Not a pipeline builder or acquirer. Over the years, we have been really focused on owning the properties. We want to own them for the long term, provide the services on the management side, continue to evolve with the times, right? Not get stale either. And really, over the last 4, 5, 6 years, multifamily industry has changed significantly. And one of our big initiatives has been to change with it and really adapt our company, lean into our culture. It's not just about the next deal, right? We think that there's reality to competitive advantage as we go forward in this kind of new time here.
Yeah. So I think you've done a good job from what I can tell from the outside looking in. Everybody that I've ever interacted with on your team has always been stellar. But how did you, I guess maybe let's cover how you got into things and then where you are today.
Sure. So going back again, it's a second generation family business. It was founded by my dad, Denny, and his partner, Randy Stokely, in 1975. And they were just back then, the stories that were embedded in my brain over the years, it was a different world, right? And they were just young, hungry entrepreneurs like yourself. When you started, they would do brokerage management, whatever. They owned a retail deal, an office deal, and those didn't work nearly as well as the multifamily deal the first multifamily deal or two that they owned. And so they really built the business on what now everyone calls value add, right? Which was not a term between 1980 and 2000. And the markets were not nearly as efficient as they are today. You could find dislocation and buy undermanaged property in a good location. And so they really built it organically through that. They were risk averse on the development side due to their prior experiences. And so they were able to organically grow the company with a deal or two a year on average. We didn't have outside capital. And over time, I get to look back and see the benefit of a long-term approach to real estate and what I think is the right way to go about it, where if you're banking on in 3 years being rich, you got a lot of forces you can't control. Where if you can have a 10, 15, 20-year horizon, over time, things typically appreciate. Now, I will say I used to joke with my dad that you spent the last 40 years of your career riding interest rates down. Watch, I'm going to spend the next 30 of mine eh, watching them go up. And I was joking at the time back in 2018, 2019. It's impossible to ignore. They did the right deals in the right locations and were good buyers. But when interest rates go down 2,000 basis points over a 40-year period, if you have a long term approach, values go up. And
Yeah.
so but then one of the things that we do that was instilled in us was just long term fixed rate financing, right? And you can't get there at the outset, but get when you can get to the long term perm, get it, lock it, and don't try to think you're going to time the interest rates. It's like when you're ready, and if it works, you lock it. And if they go down in 3 years and you have a chance to get a lower one, you can do that at that time. But so that's really been a strength for us is being in that position. Conversely, we've had a hard time competing over the last couple, 3 years, especially on the buy side. And we're hoping some of this evolves. And as we go forward, there will be some more opportunities on the buy side. But over the last 6, 7 years, we've really been focused on select site development, placemaking, where we got a good municipal partner and they want to build something really nice. And we can approach development with a long term lens, but on a one at a time, appropriate cadence is where we're at today. And then really investing and leaning into our management operation.
Yeah. So I want to talk a little bit more about development, but I want to pause on that.
Sure.
So you were thrust into the leadership through some unfortunate
Yeah.
circumstances a few years back, but it seems so you've taken the family business and really tried to spin it up into a professional organization.
Yes. That's probably fair in a lot of ways. I think what happens with a family business in a lot of cases is, especially when there's a level of success or financial success, it's good for everyone. And there's just an understood way of things and leaning into governance and things like that. That nobody really wants to spend a whole significant amount of time on those types of things. And the one thing that I learned, my dad was very, what I call abundance mindset, right? Not, I got to get the most percentage on this deal or that deal. It was like, he was going to bring it. Both of his brothers became partners in Barrett and Stokely. And it was not okay. The way he explained to me, it was like, I'm not going to worry about my piece of the pie being the absolute biggest. It's let's just grow the pie. And if we grow the pie, everyone wins, including myself. And which is the right way to do it. I think we did get to a place there where we didn't have, defined specific leadership, and just across our company, we didn't have an org chart. And this goes back 4 or 5 years, roles, accountabilities, and you just become reactive, right? You can't really, especially when the world's moving as fast as it is now and our space is evolving, you need to invest in tools and things. And yes, what I realize is I just needed to, and I'm not saying I've done a good job or been perfect at this, but we got to make decisions and we got to go, right? And just assume that role, if you will. And have really felt you just start feeling your way through it, talking to people, learning. There's a lot of information out there now and different podcasts or various things on what does a proper business structure look like and culture. And what I really started to learn, it's not magic, that it's getting good people, getting them in the right seat, having them aligned financially and morally with the company's upside and vision, and having clear accountabilities and measures. And it sounds, the part that's hard is getting there, right? Like
Yeah.
it's change is hard.
Yeah. Yeah. I like what you said about not necessarily worrying about how big your slice of the pie is, but let's just make the whole thing bigger. And that's been my mindset as well
Absolutely.
with my team and really everybody I work with.
It's more fun that way, right? So that's the piece that, like, for me, and it's not for everyone, but I love camaraderie, right? And I love team sports, right? I grew up in a tennis family. I was the youngest of three. And by default, I played tennis. I was decent at it. I didn't love it. You know what I mean? My brother and sister played in college, but I like basketball and baseball and team sports. I loved sharing in the wins. You know what I mean? And as well as in the losses, you learn with your team. And I think that's really what, for me, it's like, I met some, I'll never forget, called on some guy, 12 or 15 years ago. I had a little property in Broadrupple, wanted to buy. He only owned that one deal. And we were having a beer, and he was probably 75. And he's just made some comment about all these guys that think they're going to put their net worth on their tombstone when they die. And it's true, right? We all want to make as much money as we can. But the idea is also to have fun along the way. And for me, that team and camaraderie piece is a big part of it.
Yeah, that's interesting. I'm going to be doing with a guy, and his focus is on conscious wealth uh, creation and preservation. I gotta listen to the
Mhm.
book before I have mom, but it's the same thing. It's what? Why are you doing this? What is the driving factor behind it?
Correct.
Because you can't take it with you,
Yep.
as much as you
Totally.
try. Uh,
Totally. And it's balance for sure. It's a balance.
yeah. So you started, and you didn't touch on this, but I know this about you. You started as an analyst at a debt shop, or
Mhm.
then you moved into brokerage, and then you got into the family
Yeah.
business. And I think that's where you and I came into contact
Mhm.
when you were there leading acquisitions. Oh, the thing I was going to say, or just follow up on your point, is that building building a business or keeping a business building and evolving is not just buying deals. It's
That's right.
the soft things all around it.
No, that's the part that for me has probably been the biggest. So I came up on the deal side, and
Yeah.
the brokerage piece was really fun for me, 3 or 4 years. And then late 2008, early 2009, the market had started to fracture. There was like turmoil. My dad came to me and said, I think there's going to be opportunities. And I know you're at a place now where you can go figure them out. Right. And so if you want to, because I didn't know that it would always lead me back here. The brokerage piece is fun. You're in the transaction and there's always deals going on. Our model, especially, we don't close 6, 7 deals a year. And so it's a lot of looking and hunting. But so I grew up all the way, it was like always deal side, right? And investment side. And that's where the money's made. And when you get to a place where it's there, and there are companies built on that, and it's actually probably worked really well. I don't know how well that works going forward.
Just
Is
buy a deal,
Yeah,
fine with me.
I
Yeah.
I yeah, and that's the piece. We have great people here, like, just really good people that, like, that's a hard thing to just go find. We didn't have the organization piece, right? Like, where, okay, everybody wore a bunch of different hats. Whatever came into your office, you did. And in the last 4 or 5 years, my time, 80% has been spent not on the deal side. And so that's where we've just leaned into that piece.
Yeah. Given your experience in brokerage, I usually find a way to work this question somewhere. What do you think the differentiator is that makes a good broker versus an average versus a not so great
Yes.
broker?
Yes. I think so. There's a couple of things, and I had good fortune the to be mentored by who I consider to be one of the best. George Tickajohn is who I worked for and under. And number one, it's persistence. Like, you have to get over yourself and out of your comfort zone from the jump, right? And not you got to find a way to do that and get uncomfortable and get out and call. And that was probably one of the best things for me, just from it, was like, You got to go get it. And it ain't coming to you. And that piece, George used to always say, look, we start January 1 with zero salary. But your recurring business, your recurring revenue is your book of business, your relationship. But it's the persistence. And then it's I think the detail, transparency and detail piece of on both sides, like the really good brokers, you understand people, but here's the information, and we're not going to we're going to put as much forth as we can, give you really good information so that as you get further and further through it, you're likely to execute the transaction. Right. And so taking the time up front to understand the property and in detail, understand it, and then be able to tell the whole story.
Yeah. I guess what lessons have you been able to bring forward from your brokerage career into your current role?
Sure. So probably the biggest one, it's hard to say, but one that jumps out is there's a lot of different ways to make money owning multifamily. And I was an analyst. I'd been around our family business, understood our portfolio. We had generally a higher quality with long-term financing, asset, good location. I worked for Northwestern Mutual Life in their real estate investment group in Chicago. And they were all about trophy. Like they didn't even do much business in Indianapolis, right? They were loaning or providing equity on like really high quality stuff. And so that's what I was working on. When I got into brokerage, it quickly took me to every like corner and nook and cranny of Indianapolis and like places I didn't know existed. But also then was able to see how different people looked at things. Some didn't work. A lot of them did work. And it wasn't the same way that my dad would have done it or that the guys in ML looked at it, but there are different ways to make money in different angles, and it will keep evolving.
I was talking to
You're
a
good.
friend. I was talking to a friend yesterday, and I have this one client. He's all about basis, and he bought this one property in Memphis, and his way to add value. And Memphis can be a little dicey from what I've heard. And his value add on this deal wasn't necessarily to anything physical of the real estate. He just built a 12-foot wall around it. And
Shut up.
as a result,
Is that right?
yeah, he was able to get rents like $400 higher than anybody else.
That's unbelievable.
That was,
Only
like,
in Memphis.
incredible.
I have some good friends that from Memphis, good family, friends that are wonderful people, but I feel bad for them, man. It's sad. It sucks. From what I understand, it's a different way of life. The way you have to be on your toes down there.
Yeah. Again, I've never been there. Memphis listeners, if you're here, not beating you up, just
Great
reporting what
people.
we hear. Yeah.
Great
Yeah,
people.
exactly. So you and I've looked at a couple of your assets together as far as valuations, things like that. We've also tried to hit on some development sites. What has your experience in the development space been going? You guys are doing some great stuff up in Fort Wayne
Yeah.
and also there in Indianapolis.
Yeah. Yeah. It's been what happened for us is we got to a place in kind of the late 2010s, 2016, 17. We just couldn't compete on the buy side when we were still using our own capital. And you lose enough by enough dollars and you just realize you're not in the game. And in real estate too, and it goes both ways, but you got to look and see what other people are doing and how they're making money and
Building 12-foot walls.
yes, exactly. But there was one of the pioneers. There's a couple of folks locally that were developer specific. One in Indianapolis, Flaherty and Collins. They were doing these public-private partnerships on the development side. Pedcore and Carmel was doing these, and you just trying to understand how those work and realizing you can build really high quality if you have the right combination and you don't skimp and you really deliver. You can build really high quality deals and wanted to continue. We weren't done just because we couldn't compete on the buy side. And we competed on a couple different RFPs that we did not get, right? And then my uncle led the effort for this deal called the Seasons of Carmel, which it was suburban, quasi garden, but really nice, and proved the rents you could get if you deliver quality. And then we ended up winning an RFP in Carmel, downtown Carmel, that, and took our time and really went in. We're not looking to skimp and save nickel dimes. We're going to go all in and really build high quality. We believe that there's a market for this and we can set ourselves apart. And our timing was good on that. And when you execute a couple deals and you do them the right way, you get momentum, right? When people see it, and then you start getting calls, and it just can build upon itself that way. So that's really been the approach. Staying nimble's been a big part of it, right? There was a time 2 or 3 years ago where I'm spending most of my time on this company and the change efforts and building the structure and getting the people in the right seat. And I'm like, we're missing deals. That feeling of FOMO effectively.
Yeah.
In hindsight, we feel a little bit fortunate, right? That we were taking our time to get the right people in place. And as we started looking at deals, when we first came over with Andy, as he started to look at sites in Cincinnati, it was a whole different world 6 months later. And it moved so fast with costs and rates, right? That the whole kind of game plan changed, and this doesn't work. And that's where we're at now, is just really trying to work hard to find the right deals. And you just have to know they're just not that upside that people got up until 18 months ago. And some of those big hits, you just can't anticipate that coming back.
Yeah. I think some of that all gas, no brakes, let's buy it at any price formula, you're starting to see some of those deals
Yeah.
struggle.
Yeah, it's all behind the scenes, right? It's all not, but people are talking about when you sell something, make 20, $30 million. But no, when we're not, to say we haven't had different struggle times, but nobody's bragging about having to write a check for $4 or $5 million to pay down a loan. Nobody's talking about it. You don't announce those things, right?
Right.
You don't have a closing ceremony for those. So there is stress out there. I believe it's behind the scenes. It's the one nuance to this cycle that's new, right? It's been 40 years since we've had an inflationary cycle, but is this private credit world. And so there's this off ramp out there. I think part of what's going on and why you're not seeing more deals where lenders are saying, you got to pay me off, pay me down. This world of private credit is big, and they're coming in and they're paying that lender off. Their money's expensive, but essentially I think what happens, I don't know the structure, a smaller developer moves all the way to the back of the line, but you don't get foreclosed on. You're not forced to sell at a discount. You can live to fight another day. And maybe if everything comes back, there's some juice at the end. And that it's happening. And it's the evolution of the capital markets piece.
You're talking about like debt funds, essentially.
Debt funds, and yes, that kind of money. Exactly. And it's typically smart, sophisticated, but they're providing it's a solution, even though it may not be great. Like, it's better than this or that.
I want to go back to what you were talking about a little bit in the development space. And I'm confident I've mentioned it before, and it's a philosophy that I have learned through my years is you offer a clean, safe place to live and respond to maintenance requests. You do those things, you always have tenants. But then if you take it a step further and offer the nicest units in the market, you're going to have the best tenants. So I'm wondering if you can, because I'm in the midst of
Sure.
just a small 6 unit, but
Mhm.
that's the philosophy I'm
I think
following.
that's right.
Yeah.
And most people know this, but the shift as part of the way multifamily shifted coming out of the Great Recession in the 2010s was for the first part of my career, you only lived in an apartment if you had to because you weren't yet able to buy your home, but your first home by and large in our markets. And we couldn't, like, there was no, granite was condo quality, right? Hard service kind of. And coming out of that Great Recession, and I give the developers a lot of credit who timed that and picked up land positions like in 2010, 2011, like seeing out that like the single family thing is which could mean big things for multifamily. That took some real vision. What changed the game was just the level of quality, and then people realizing it, like the combination of the math is not just your mortgage payment compared to your rent payment, right? Like
Right.
when you own a house, there's a lot of other things that you got to pay for to fix that aren't you don't see, right? And
Right.
between that and then people saying, "It's renting in a nice community is nice. I'm not in a hurry to buy in my home. I don't know where I might want to live next year." There's been a fundamental shift now, and I think up till recently, I've called it the golden age of multifamily, right? You have just this amazing fundamental supply demand that just worked really well. The capital markets and efficiencies and more smart people coming into the space. It just, it drove this wave of quality. And so I went off track there, but back to your question, it I think that we've entered a new space where the level of quality at high end, people know rent by choice, like that's a legit option. And that's
Yeah.
a legit for you look at our rent to income ratios on some of these properties and it wow, like this is clearly a intentional decision.
Yeah. A rental by
And
choice as opposed.
and then you have I guess then to finish that thought, the way I think about it is you have the upside in there are different approaches, but for us, it's always been in the rent, right? You can do some things here and there to manage expenses, but your top expenses on your P&L is your debt service and your taxes. And then you got utilities and insurance and other things out of your control. Yeah, maybe you can squeeze some out of your site staff costs, right? With some technology and get some centralization of leasing down. But it's there's a ceiling on how much you can reduce expense, especially if you got to hold it for the long term because you got to fix stuff and you need good people. If you can get $50 more per month because you bring a superior level of quality and service, and you can do that repeatedly over time, that's where the value creation happens in my mind.
Mhm. Yeah. Yeah. I think that you touched on it. A lot of people who aren't in our business, they're just looking at, oh, landlords are making all this money. The taxes, like on a per unit basis, are sometimes more than the whole rest of the,
Yeah.
the expense load.
Yep.
It's crazy.
No, and that's one of the big, if you look at risk and you try to evaluate the different types, I mean, that political risk or whatever bucket you want to put that in for the taxes, you've seen it in Ohio. When it gets wonky, it can shut a whole investment sales market down, right?
Yeah.
If buyers can't underwrite and it can make a deal that was a good deal, a really crappy one with a big reassessment. And the problem is, I don't know how you ever really explain the whole understanding of that to the powers that be.
Yeah. I don't know either. We saw one deal where they got fully reassessed and it essentially made them underwater.
Yeah, that sucks.
Eh,
And the problem is, like, when you talk about these deals, then there's big amounts of money at risk. Oh, taxes go up this much. Yeah, but all of our equity now is gone. You know what I
Mhm.
mean? We put $10 million into this deal, and that move, you just scraped it all. And that's tough.
Yeah.
What there needs to be is just consistency. You know what I mean? Like in that piece, and you got to get level set in a way that doesn't make people bankrupt, but you have to have predictability of some sort. I think it's only fair, right, for everyone, better for a municipality or a school district if you know what next year's going to look like or 3 years down the road versus, oh, we need money at whatever that, for whatever reason, those three deals are going to go up by double and everyone else is going to stay the same.
Yeah. And it seems that there's not a lot of rhyme or reason unless it is a market where you get reassessed no matter what. And
It depends.
if
Yep.
that's what it is, that's what it is. It's fine. But
Okay.
other times you might not get hit with
No,
reassessment.
totally.
And how do you quantify that risk?
There's a lag too. I saw this in like 2006, 7, 8. There's a lag because, like, inevitably, when cap rates get super low, they don't stay that low. And so you
Right.
get a window of 12, 18, 24 months, and values are really high. And then everyone hears about it or gets comps on it. And by the time then the new assessed values are coming out, like cap rates are no longer 4. Today
Right.
they're 6. And if you're not, that's where the market approach gets really hard.
Yeah. Yeah. If that's the case, then you got to reassess like almost instantly. And but that's a whole chaos and
And real
stuff.
estate's illiquid. Yeah, it's a real concern. I think what you're gonna see is you're just gonna see more investment capital to go to sophisticate to where they have some predictability and understanding on that piece,
Yeah.
because you can't go somewhere if you could be way off on your underwriting for taxes.
Yeah.
Hard to take that risk.
Yeah. Back to Barrett Stokely. You mentioned it a couple of times and we talked about it early on too. You've mentioned getting the right people in the right seats. And if you want to name your best people or not, what does that
Mm,
mean to you?
it's really interesting. I had an opportunity last February. I may have told you this, but we hired an executive coach 6 years ago, maybe, or went out and looked and sought out different consultants and or found this coach. And initially, when we start on some of the things and core values, I'm like, this is hokey, like really. But once you really get into it and you realize the importance of those things, this is essential. But through him, I got an opportunity to go to it's called like a, I don't know, work study or something with Jim Collins. So Jim Collins who wrote Good to Great and Great
Oh
by
yeah.
Choice and Beyond Entrepreneurship. He's probably the last 50 years, probably the foremost business management leadership. There's a guy named Peter Drucker that was before him, but he's brilliant. And Jim Collins is brilliant and he does the research, right? He's like a researcher and a teacher, and the data is real. And it's just basically what his base case study in Good to Great is, why do some companies go like this? And
Yeah.
he's got all the comparisons with the peers, and then he defines it. And I got to, there were like 15 or 20 people. It was 2 days in his office in Boulder, Colorado. And you go like his conference room, small little conference room there. And there were people from around the world. I don't know how I ended up there. I don't know, imposter syndrome a little bit, but was the, this is where Bezos created his flywheel in this conference room. It's like legit. And the first, like you're in your seat at 8 a.m. sharp, and he comes in right on the dot, and he take out your pencils. And all right, I want you to write down the key positions in your company. There should be 5 to 10 of them. And then he says, now I want you to put a check mark next to the one where you absolutely have the right person in the right seat. And you go through this exercise, and then he says, okay, raise your hand if you have 100%. Man, raise your hand if you have 90, if you have 80. And most people are in like the 40 to 50% range. And that's the most important thing. I don't care about your strategy. He said, I've seen it time and again. If you have the right people on your team, you can go do anything and be good at anything. And it makes sense. But it's also, and so you leave there and you're like, yes, that's what I'm going to do. But it's hard as well. Right. And so that's been really at the core of what we've been trying to do over the last few years is getting a team where there's experts who share the core values and who bring are unique and of themselves. They're not all clones, right? And bring
Right.
unique thought angles. And so the one that we've been looking for a while to hire a CFO and 6, 9 months. And we found him and it took us 3 or 4 months to recruit him. He was feeling us out and he started a couple weeks ago and he's already that value. It's like you can already see it and it's amazing. We've got our kind of management side, ops side, investment development, accounting, finance, and getting not to go too far in the weeds here, but really what the trick we have an operating business and we have an investment business and they're accretive to each other, but really getting them to connect is hard. And
Yeah.
so that's the piece that we're continuing to work through so we can have the team camaraderie, but also the ability to make informed decisions quickly from an investment lens based on operational information.
Yeah. That makes a lot of sense. This has been great, man.
Yeah,
You're a super
I
hard
put you
person.
to sleep. I put you to sleep.
No, it's good. This has been, like I said, you're one of my favorite people to talk to. I guess we'll wrap it up here.
Yeah.
But
Let me ask you
yeah, let's
a
go.
question. What has been like the biggest benefit for you to doing a podcast? Uh,
Honestly, I think it has, when we first started talking, I was very much just hammer the phones. Are we going to
yeah.
do a deal or not? And if not, I got to find somebody who is. I don't have time to, I don't have time for this. And
Yeah.
I think it was noticed by one of my peers. I hadn't seen him in a while. And they're like, yeah, I can see that you've slowed down and calmed down. And it's helped me be more thoughtful and ask better questions of prospects and be able to. So I've had to have some difficult conversations and it has given me the ability to think through what I'm going to say. And hey, this is how I see it from my perspective. I'm
Totally.
not yelling at you or anything, but what's up? And honestly, I think being able to have these and sit and listen and not just try and interrupt, which is never really my style anyway, but I think it's given me the benefit of having some of these long form conversations because you and I will talk for a half
Mhm.
hour, but then it's like, all right, I got to go. And I'm already having a lot of these conversations anyway.
Mm.
So why not just put them on Zoom and put them out there?
No, that's good. I think that's good. The part too about asking questions is really important. I'm trying to get better at that piece. And it's telling doesn't work the way you want it to, right?
Right.
When this is how you do it, this is how it needs to be done here. And it's this leadership coach, one of his cheesy sayings that I like it, listen to learn, has to empower, right? And it's, can you get to the same place or likely a better place, but using a questioning kind of approach with someone, right? Because and this is something where I do it at home too, but I know the answer. Here's how you do it. If you do this and this, then this will happen. So go do that. And it doesn't always work, right?
No, no, it doesn't.
That's part of the growth and why I love podcasts too, because of there's an open people share and there's so much content in the world. It's okay, but there's really good stuff if you can like distill down and get to the things that are going to help you grow.
Yeah.
And that's what I love that you're doing. And I admire it that you've taken it on. I think it would be really fun.
Yeah. I think it's strengthened some existing relationships and helped me establish new ones. And I'm at a point where people are asking me to come beyond. Yeah, definitely.
I like it.
Yeah.
So what if you one thought I've had is what if you then it's like how do you get someone really open up and like personal, but not in a weird way, but
Yeah.
it's like what's the craziest thing you've done in the last 20 years? And see if you can get it to where it's like combination of business and personal. I don't
Yeah.
know. I'm just spitballing.
No, that's it. It's a good idea. I've tried not to do. I've had some instances where people say things I'm like, "Well, you're blatantly wrong." Um,
Yeah.
so I try not to get confrontational.
You
Uh,
can edit this part out too if you want. I don't care.
no,
You can edit it whenever you want out.
we're gonna roll. We're keeping it rolling. But yeah, like I think what what I'm trying to do is learn from
That's
guys like
good.
yourself who are you're a successful businessman, and I look up to you and I admire you. And
It's mutual respect, right? And that's where your story, which I don't know if ever goes, but like the thing with brokerages, it's hard. And especially if you don't have a team around you and a
yeah,
mentor, like it takes and I have a lot of respect for successful brokers, especially ones who had to bootstrap it and start it from nothing because it is not easy. And
no,
it takes a level of like grit and determination that I'm going to do this no matter what. That is, it's admirable. And
yeah,
I think sometimes people in our industry, especially if, oh, you make so much money, you sold a deal and you made a 6-figure commission. Shoot, I want to do that. You know what I mean? But it probably took you a little while to get to that first 6-figure commission, is my guess.
for sure. And yeah, there's some that it's a roller coaster. And what
Mm.
I've learned in brokerage is you just have to try and maintain as level as you can.
Yeah.
Like when you
Yeah.
have your big hits, your big wins, you have to relish it, but
That's
you
good.
can't get high on your own supply, because the next day you're going to get kicked in the teeth, and you have to be able to take that rejection or whatever it is with
Yeah.
the same. All right, yeah, great.
That's
Hey,
really good.
thanks so much. I really appreciate that. I'll talk to you next month.
Mhm. No, that's really good. I think that's such an important piece, right? Because we all want to celebrate the W's, but it's all business and life. You're going to have more L's than W's, likely,
Yeah,
way more.
yeah,
And you got to pick yourself up and let's go. But yeah, that the persistence and fortitude to grind through and build your own business that way, that's legit. And not that many people have it. You know what I
no,
mean?
no. And you can have an interview with somebody and they interview great, and you can see somebody and say, I think this guy's going to be great. But then what happens is you bring them in and they have a burst of energy initially, and then they end up getting lost in their spreadsheets is what
Mhm.
happens. And they just stare
Yeah.
at the screen for
Yeah.
hours.
It's easy because it's easier. It's more
Oh yeah.
comfortable.
Oh, I have to research this. And
Yes.
what if you ask me a question and I don't know? No, you need to freaking pound the phones.
So how do you get them out of that? So if you get to that place, have you ever been able to get one of those young guys or gals to make the shift or do they just have it?
They have to want it. They have to independently want it. And
Yeah.
you can say that I want it verbally, but then it has to be inborn within them.
Yeah.
And they might want it when they come in, but when they actually see what it takes,
Yeah.
and oh, I made 50 calls today and I got 2 people on the phone. First of all, you're not making enough calls. If you're right
Mhm.
there, even if you're part of a team, you're not making enough calls.
Mhm.
And I found that literally the harder you work, the luckier you get. And it'll be the last call of the day that I'm just feeling terrible. And then you get something and you're like, oh my God, that was great. And you're
Yeah.
amped and hyped again. I've had a couple of guys just spin out and there's no malice. All right.
Sure.
And
It's hard.
if you don't want me here, I don't want you here.
No, that's right.
It's a waste of everybody's time.
That's right.
But
No.
we've got some guys. We've got a guy in particular. I have so much love and admiration and respect for him, and I think he's going to be great at this. It's just he's got to get, and we have him in a servicing role,
Mhm.
so that's a softer entry in
Yeah.
than just go pound the phones and figure it out. So
Mhm.
it's all about skill sets.
That's it. But the one thing I will say too about, but it's hard to think of a base skill set if you can do it, the brokerage piece, because you learn. And look, everyone thinks grass is greener. I want to be an owner in owner school. And I want to be a broker, making and not taking risks on development or whatever. But it's always that. But if you can do it, you then you can do whatever you want. You know what I mean? Because
Yeah.
it gives you the analytical piece, the understanding of real estate and places and things, and the sales and dogged determination piece.
It's given me so like ever since I was a kid, I wanted to be in real estate, but I never pulled the trigger until just recently on buying my own stuff because I felt like I didn't know what I was doing enough. And so brokerage gave me, you see so many deals, and that's
Yes.
where I learned those things. And then, okay, I know how to run these deals better than the people that I'm dealing with. So let me try it on my own. And I'm getting my ass kicked
I like it.
on some things, but
No, that's right.
it's small enough scale where it's not going to kill me.
And you know what should work, right? That's the other piece. It's you're in it all the time. You've seen it enough times. You're like, if you did this with and that should work. It doesn't always. You got to get to the place where you trust your judgment and analysis, right? And it's always moving. That's for sure. And I think our industry, it's the next 3 to 5 years are going to be really interesting. I just think it's not going to look like it did a few years or anything previous. It never does. This is a different time. And when you have 2,000 basis points over 40 years,
which first
and
of all, that
game
is just an amazing statement in and of
Yeah.
itself. 2,000 base, that's 20%. That's incredible.
It's incredible.
But
That's right.
keep going.
But real estate was always based on positive leverage, right? Like it's a business based on debt. If I can buy or build to an unlevered return that is higher than what I can borrow for, then I can juice my return on my equity. And it's not there. Like today, it is really hard to get there. And you can only do it based on the com today. And there's still a pretty big gap, right? Between especially if I always grew up using amortizing debt, underwrite deals. And I think at the 5.5% rate is got to be a 680 or something debt constant. So you got to be unlevered really close to a 7, right?
Yeah.
Or why would you do it?
So what was so interesting to me, I got TREP, which is a loan monitoring service back in like 2013, I think.
TREP. I remember TREP.
Yeah. And
Is it still around?
yeah.
Okay.
And what was fascinating to me was I looked at all the owners in the market and I had the same thought too. And that was how I was taught is you have fully amortizing debt. So many of them had full term interest only. And I was like, what?
Yeah.
That doesn't make any sense. But then, and I would ask him, I was like, it took me a while to figure out how to ask the question.
Yeah.
It's like, it's not about paying down the debt. It's about cash flow.
That's right.
And I was like, oh, okay. Sure.
Yeah.
If you frame it like that, it makes sense. But if you think about your house, you theoretically
Totally
want to pay off your house.
Yep. But if you start on it makes sense if you think about Fannie or Freddie, you can borrow 75% loan to value if you amortize it, and in 10 years, you're at this number, or I can give you interest only at that number today, because at the end of 10 years, we're going to be at the same place as far as your outstanding balance.
Yeah.
And so it's okay, because we've done some of those long-term IOs, and it's so long as you're not levered up on them, then
Yeah. And
you
your underwriting
can.
assumptions aren't crazy.
That's right. That's right. If you,
I'm going to shamelessly plug what I'm doing to
yeah,
kind of,
do it.
well, dovetail off of what you're talking about. The next 3 to 5 years are going to be so different because, like, when I first started, I literally just had the auditor's website and I had to manually look everybody up and figure out
Yeah.
whose address was what. But then platforms have come along that are essentially like encyclopedias. But what we're doing is actively predicting which deals we think are most likely to sell. And there are others that are trying to do it. I think we're truly, if we're not the
Interesting.
first, we're pretty close to being first. And it's like,
I like
all
that.
right, I still gotta call you and be persistent and all that. But it's, hey, Brian, you've got, because normally if I say, hey, Brian, you have 20 properties. Do you have anything you want to sell? Your knee jerk is going to be no. But if I call you
Right.
and I say, hey, Brian, I'm calling you about this specific property.
Hmm.
Oh, that's interesting. We were just talking about that.
Yeah.
And let's talk about
Yeah.
right place, right time. So that's what we're trying to do. And
That's
that's
interesting.
technology.
That's interesting. That makes a lot of sense. No, I think that's right. And even it's tracking over time through conversations. Like, okay, he mentioned these three, keeping those in mind. What do we know about them? But I
Yeah.
think that's right, because it is where we're trying to get, and we're going to get there, but where we've got the investment information and it's current and it connects to the operations, so that we can make quicker informed decisions
Right.
on the buy or hold, sell, refinance, recap.
Or- Exactly. So I was talking about the brokerage or acquisition side, like here, the property is most likely to trade. But what we have in mind for guys like yourself is, okay, here's your portfolio. We have the information on it. Here are the ones that we think are most ripe
Yeah.
for harvest. And then, oh, by the way,
That's interesting.
yeah, here's
I
what,
like that.
based on your current holdings, here are the ones that we think, here are properties that aren't in your portfolio, but are likely to come up for sale that we think you might be
Oh,
interested in acquiring.
yeah. That's good too. I like that. One of the things that we wrestle with is we've evolved our portfolio over the years to get better and better location. And we don't have any obvious, like, locationally or asset. There's good stories to all of them,
Yeah.
good reasons to hold them, but also sometimes it's hard to sell when the property's really performing well, but that's also the time to sell it.
Yeah.
And we've all done that before. We're like, oh, this thing's awesome, I want to sell it. And then goes by and you're like,
Then it
shoot.
shifts and you're like, oh man,
Yep.
I could have had 10 million more in proceeds.
All day. Nah.
All right.
But
With that, we're at time. And I know you're a busy man. You're busier than I am probably. So
no, I just have 4 kids. That's the thing that keeps me going.
we'll wrap it
But
there. But
all right.
let's chat for a few minutes afterwards.
Okay.
I'll cut it. Just catch up. So
Very
Brian,
good.
thank you so much and hope you have a great
Yeah.
rest of your day.
Thanks for my first podcast. I appreciate it. Here. All right.
Bye.
Bye.